I don't want to jump into my topic just yet because I see a lot of you starting to doze off already. It's very late in the day. And usually what I do when I'm slaughtered at the very end of the day is I tell a joke to wake you guys up. Do you want a joke right now? Okay? After this joke, I hope you can follow me. I know there's a lot of things that has been going on for the entire day. I just want us to enjoy ourselves as well. I'll start with this joke. There's a 9-year-old boy. He asks his father, "What is politics?" Right? The father think very hard because the question is a very intelligent one, right? The boy asks a very intelligent question. So the father says, let me put it this way. I provide for you. I am the capitalist. You are the people. Your mother keeps the money. She's the government. The babysitter is the working class, and your baby brother is the future. Do you understand? Then the boy said, maybe. Then he went to bed. While he was asleep, he heard his baby brother crying. So he went to his room and checked out his baby brother and saw that the baby brother's diapers, the diapers is in a mess. So he wanted to communicate with his mother. He went to his mother's room and saw his mother sunk asleep. Very deep sleep. Then he said, I don't want to bother my mother. Then he went to the babysitter's room and peeked inside the room. He saw his father having an affair with the babysitter. He decided not to disturb them either. So he decided, I couldn't do anything, I just go back to sleep. The next morning when he wake up, the family was having breakfast, eating together. The boy said, Father, I think I know what is politics. Then the father said, good boy, tell me in your own little way what is politics. Then the boy said, sounds something like this. When the government is asleep, the capitalist screws the working class. The capitalist screws the working class. You know, you're getting the joke, right? The capitalist screws the working class. The people is ignored. And the future is in deep shit. That's my joke for you guys today. I hope you guys like it. But on a more serious note, I get your attention now. I hope I get your attention now. Everybody's awake, right? I'm not going to tell you what to buy, what to sell. I'm just going to impart you a couple of lessons. Right? I'm a bond guy. Bond is nothing very complicated. As I said in the beginning, it is just a promise. When you lend your money, you give your money to somebody, what do you expect in return? Get back the money. Simple as that. Okay? But why is it so important for you to consider bonds today? This is my job on stage today. Before I talk about bonds, I will give a very brief background. I'll start talking about equities, your stocks. Everybody likes stocks, right? What is stocks? When you buy a stock, what are you buying into? You are actually buying into an ownership, right? You own a business. And when you own a business, you hope that the company becomes the next NVIDIA. You hope that the company becomes the next Amazon, the next Meta, Facebook. Correct? because you are participating in the future of the company. Follow me? This is how you think when you buy into stocks. But for bonds is just a contract. If you want to remember bonds in one word is a contract. A contract between a borrower and a lender. When the time comes, you pay me the interest. When the time comes, mature, you give me back my principal. That's it. Okay? So the mindset of investing in bonds and equities is vastly different. Right? One, you're thinking about the future. The other, bonds, you're thinking about the here and now. I don't care if the company might be not doing so well. Maybe they could go elsewhere to borrow more money to pay me back. Is that fine for bond investors? That's totally fine. So the things that we look at when we choose a bond is very, very different from picking a stock. Okay? This is the fundamental. I'll skip this. Not very important. I want to ask you guys a question. Are there any free lunch in this world? No. There's no free lunch in this world. Right? What is the cost of money? Have you ever thought about that? What is the cost of money? The cost of money is interest rates. Correct? Because there's a price that you pay for money, and that is interest rates. Remember, there was a time where interest rates was almost zero, a very low interest rate environment in the US. In the Europe, it went to a negative interest rates, right? It means that people are getting free money, right? When people get free money, what do? They speculate. They spend it on probably unproductive things. That's when you see the rise of all this NFTs, right? You got your NFTs, you got your cryptos and all this. I'm not saying that it's not a good thing. We can have a separate debate about it. But my point is, today, the interest rate environment is higher. Follow me? And if you are a business owner today, you're going to scratch your head. Why? Because you need to work harder to make sure that the money that you borrow can make higher than the higher cost of interest rate that we're experiencing today. But the good news is what? The good news are maybe we are not business owners. We're investors. I assume all of us are investors here today. So we're on the other side of the equation. And because we are in a higher interest environment, we get to enjoy the higher returns coming from the higher interest rate. So today is a very good time. I'm not saying that it's the best time because interest rates are coming down, right? We all know that interest rates are coming down, except for a number of countries. But generally, broadly, we're not going to go back to the days where interest rates are extremely low anymore. So you can enjoy a higher interest rate and enjoy a higher return for investing in bonds. That's my message from this slide. Okay. Early this morning, I said what? If you guys are here, I asked you guys to do a temperature check. Remember that? And this is a quote. We don't know what's going to happen tomorrow. We don't know where we are going. But the least that we need to know is where we are today. So we're going to do this temperature check. I'm going to use the US market as an example, right? There's a lot of market in this world, but just to illustrate my point. This is the S&P 500 forward PE ratio. What does that mean? PE ratio means what? PE ratio means how much are you willing to pay for 1 unit of earnings of a company. Can you follow me? Right? What does this S&P 500 forward PE graph means. This is the entire market. How much is the market willing to pay for the top 500 companies in the US market, in the S&P market, for every dollar of their earnings? This is an aggregate, okay? And this chart, it's at 22, around 22, 23 today. Right, this is 21st of December. You can Google. Roughly, it's around 22 and 23 today. And there's a study done by JP Morgan. Right? JP Morgan is here. The study says that if you buy into a market that is valued at 22 times or around 22, 23 times, the next 10 years, every single time in history, from 1987 to 2014, every single time, if you buy into a market that is valuing at 22 and 23, the returns for the next 10 years is going to be negative 2 and 2. I'm going to repeat. If you buy into the US market, S&P 500, with a PE ratio of around 22, 23 or higher, the history tells us every single time from the year 1987 to 2014, the return that you are going to get for the next 10 years is going to be negative, between negative 2 and 2. Think about that. What does it say? It means that the price that you pay matters. The price that you enter the market matters. I hear a lot of investors coming around and say, just buy ETF lah. Buy S&P 500 lah. It's because of the laziness of the market. The passive investments can become inefficient, right? This is how things can change, the nature of things can change. But the lesson here is that the price that you pay to enter a market actually matters. I'm not saying that it's overvalued, right? Overvalued and the market crashing tomorrow is not synonymous. But how would you think about your portfolio? Today, are you still trying to hit more winners? Or are you trying to keep your money? That's my whole takeaway from my sharing today. Right? Do you want more winners? Do you want to go offense? Or do you want to take a step back and say, I'm going to change my posture to a little bit more defensive? This is a question that you have got to ask yourselves every single day, depending on the situation of the market, right? Whether or not it is a time for us to recalibrate and look at our portfolios and say, okay, Tao Hong showed a very nice graph and said that US market seems to be a little bit on the high side. I'm willing to adjust my posture to a more defensive posture. So this is something to ponder for everybody here, right? Do you want more winners today? Or do you want less losers? This is a question. So, I'm almost at the end of my sharing already. Bond is very straightforward. It gives you a promised return regularly. A lot of you guys might have experienced bond funds already, right? Bond funds, they are diversified. They pay you income distribution. If you want to enjoy the income, you got to sell your units, right? You got to make an active you got to take an action to sell your units. But if you're buying into direct bonds, if you're buying a number of them, every 6 months or every regular period, you will get your money inside your cash account. That is a very straightforward mechanism. And this works very well for people who are planning for their retirement or even retired already. The reason why is because you might not have an active income already. You need that supplement of income to live your life. And you are not willing to let the market ruin your plans in life. So direct bonds will be able to provide you that stability and the predictability of that cash flow. That's about it, right? There is a need that bonds are serving. I'm not saying that bonds are meant for everybody. If you're a 20-year-old guy and came to me just now, I said bonds are not for you. Please go away. 20 years later, come back to me. Right? It's not for you. But there are certain needs that direct bonds are serving. And that is the predictability and the stability that you are receiving in cash. And that helps a lot of our retirees to plan their life, to spend that money. Okay? Now, this is just an illustration of the cash flow. You can build your own ATM machine, I say. You can build your own ATM machine. So, in conclusion, why do you need bonds today? 3 points only. First, remember I started by saying we are in an environment where interest rates are higher. So the absolute return for bonds today are generally higher, right? So as investors, we get to enjoy that higher absolute return. This is point number 1. Point number 2, it is competitive with the returns, the historical returns of equities. What do I mean by this? Some of you guys would challenge me and say, Tao Hong, the study shows that if I put my money in the S&P 500 for 100 years, 1 century, every single year my return is going to compound 10%. That's the study. If you put 100 years, your money in the S&P 500, a broad index, the history tells us the compounding returns is 10% every year. Why do I need your bonds? I just leave my money in the index. Right? When I say it's competitive, it means that today you can actually get safe bonds that are issued by big banks that can easily pay you 5 to 6% in the right space. Right? We do have that. So again, the question is, do you want to score that goal? You still want to continue to score that 10% every year? Or you said, okay, I'm going to take a step back and I'm going to be happy because I want a peace of mind and I'm happy with 5 to 6%. Okay? So this is the trade-off. Are you willing to trade off the upside for protection, for peace of mind? And the third question, back to the very basics. Bonds is a contract. A contract means that it's a promise between the borrower and the lender. And this contract has a very, very interesting incentive. And the reason why is that if an issuer of a bond does not make good on its promises, if they default on their bonds, as bondholders, we can go after the company and wind down the company. Imagine you're a businessman, you work your entire life to build the company. And if you default on your bond, the creditors come after your company. It is a very huge incentive for businesses to repay their bonds and their obligations. And this is actually exactly true for a lot of companies in Malaysia as well. right? I'm not saying that there's no default. Whenever there's risk, whenever there's returns, there will always be default. But I'm saying that the incentives for companies to pay back their obligations is very high. This is our experience. Okay? So I'll end my sharing again. I've said this. I will say this to the WhatsApp group of my family. I'll say this again. What is the end goal of investing? Some people might think that it is to get rich. Some people is thinking, I want to beat the market. If I can suggest what is the end goal of investing, it is to preserve and grow your wealth. Because when you start with preserving and growing your wealth, then you will not do anything to put your lifestyle at risk. Right? Because if you think that I want to get rich by investing, then you will start over-concentrating your portfolio in certain places. You're going to take unnecessary, excessive bets that you cannot stomach. These are human nature. Okay? So I'll leave you with that. And I just hope that your 2026 will be filled with things that matters to you most. Thank you very much.